Large fund administration companies want to check and test your knowledge on some very basic concepts, but they will not ask you questions directly. They want to know how quickly you can think, how you're able to segregate the thoughts, how you're able to identify the differences, how you're able to clearly think on your feet, because that's what organizations are all about, right? Organizations are not to go back to your textbook and check the answers. Organizations don't want you to go back and check what is the conceptual fundas. They want to know on the field, at the job, at the desktop, with dealing with the client, how quickly you can think, how fast can you segregate the ideas, how quickly you can come out of a tricky situation, how will you handle those pressures. And therefore, they ask you some very tricky questions in order to help you get there in the right job. Hello, everybody. In this 7th video, let's take a look at what are the kind of tricky fund interview questions that fund administrators ask at interviews at beginner levels. The first one, a simple question could be, what's the difference between a stock split and a bonus? Now, we've all studied this in our graduation courses. What is a stock split? What is a bonus? We have even gone into distinctions between them. But the basic difference is it the stock split increases the number of outstanding shares, bonus does not increase the number of outstanding shares. Does that sound right? No. Stock split decreases market capitalization, bonus increases market capitalization. Is it C? In a stock split, power value of the share decreases, in bonus, power value of the share remains the same. Or is it D? In both stock split and bonus, power value of the shares decreases. Now, if you're approaching this question from a market's point of view, everything seems right. But if you're approaching it from an accounting point of view, then the right answer is indeed, in a stock split, power value of the share decreases, in bonus, power value of the share remains the same. Because in a bonus issuance, the reserves are capitalized and therefore the face value or the power value of the shares do not decrease. Let's go to the second question. An American option. This is with regards to derivative products that are traded across the market, especially in New York Stock Exchange. An American option is an option that A, can it be exercised only on expiry? Is it B, can be exercised any day before expiry? Is it C, can be exercised only beyond expiry? Or is it D, can be exercised only in America? So the way the term is coined, there are different types of options depending upon the settlement methodology. Those are American options, European options, and Bermudan options. And therefore, the trick question over here is, if you've not really brushed up your basics, an American option can be exercised any day before expiry. Okay, even in India, we can trade them. It's not necessary that they have to be listed only in America. In fact, American options can be traded anywhere in the world. The logic depends not on the country where it is located or traded, it depends upon the methodology or the style of settlement. In corporate actions, record date. The corporate actions is a large job in fund administration companies, and therefore they want to check your knowledge about the dates. So you know the dates, you know the sequence, and suddenly they'll ask you, record date is the date for recording the corporate actions? Is it B, the date for recording the announcement of corporate actions? Is it C, the date for recording shareholder approval? Or is it D, the date for recording list of shareholders due for entitlements? Now, everything is recorded, okay? This is a really tricky question because each one of this is recorded, right? Because if they're not recorded, then the company just cannot announce the corporate actions. So the right answer is indeed the record date is the date for recording the list of shareholders, okay? Because only they are entitled to the entitlements. A forward contract. Now we're going back to derivatives because they know that derivatives is a tricky aspect since you covered it only in the last year of your accounting courses. And therefore, they ask you questions on derivatives. And hedge funds do a lot of derivative trading, especially in the OTC markets. So let's take a look at this question. A forward contract is an example of an OTC contract. Is it B, exchange traded contract? Is it a futures contract or is it a spot market contract? The right answer is indeed OTC contract. Over the counter contract. It's highly customized. It's designed to suit the requirements of both the counterparties to the trade, and OTC forward contracts, in fact, are traded highest in both foreign exchange markets as well as in commodity markets. Almost all hedge funds do a lot of risk management technology techniques with respect to forward contracts. They work aggressively in the field of forward contracts because they need to protect the risk as well as take risk. And finally, the fifth question, the USD Libor. Of course, Libor is a history now, but what has it been replaced with? They want to know, do you understand benchmarks? Because your accounting courses have taught you only Libor. They haven't updated themselves yet to the newer benchmarks. So have you kept yourself abreast of the latest details of the market terms the USD Libor has been replaced with? Is it SOFR? That's the secured overnight financing rate. Is it B, Sonia? Is it C, Esther? Or is it D, federal rate? And the right answer is indeed A, SOFR. Okay? Oh no, B is not the right answer. It's A, SOFR. Okay? Thank you so much for everybody for listening into this video. My name is Sushila Hariharan. If you're interested in a career in fund accounting, corporate actions, OTC derivatives, and trade life cycle, do subscribe to my YouTube channel. Thank you so much, everybody.